One of the things about our show is it's going to be unique.
You are what you do. You can say any amount of things that you want to say, but what you do is what everybody sees.
People are like, oh, I'm just going to JV it. Like, let's just JV it. Like, what the hell is that mean?
I cannot tell you how excited I am to hang out with you guys today, so thank you so much.
Well, then that end buyer could come back and say, well, I didn't fully understand that it was subject to.
That's not a thing. Like, the SEC has thought of all of these things. They've been here since 1932.
And you can do what you want with your property.
Buyers have time, they have negotiating power, they have options.
Oh my gosh, I am blown away by your inexperience, and they've been in business 20 years.
And that includes things other people put on your property, right? It's your property to be okay. Suddenly, Cousin Jimmy's in a lawsuit.
A novation is replacing one contract or one obligation with another.
Out with the old, in with the new.
Yes.
Good morning, everybody. Welcome to the show and Happy New Year. It is 2024, and what better topic to discuss in the new year is avoiding tax pitfalls for the new year. I'm Andy Fowler, and I'm here with Sean St. Clair. If you're new to the show, make sure to like our channel. You can find us on YouTube, you can find us on Facebook, and you can find us on X, formerly known as Twitter, and you'll find us at the handle @InRem Podcast. That is @InRem Podcast. Also, make sure to download the audio podcast. Sometimes that's easier to listen to. Doesn't cost you any money. You can download it right onto your phone. You can find it on Spotify. You can find it on Apple Podcasts or any of the other major downloadable podcast platforms. With that, we're going to go to Sean, who has our legal update.
Thank you, Andy. So our legal update today is, what is a joint venture agreement and when should it be used? So I see in practice a lot of joint venture agreements. I see people using joint venture agreements, and sometimes they're used correctly, sometimes they're not used the right way. So basically, a joint venture agreement is a partnership agreement. It's basically two or more parties coming together and agreeing that they're going to enter into some venture, i.e. a joint venture, some project, some investment together. And that joint venture agreement then basically defines the relationship of the parties, provides certain mechanisms as far as, how the parties are going to be compensated, when they're going to be compensated, who's going to, maybe maintain the books and records of the property. If it's a real estate venture, who's going to maintain the bank account for the joint venture, who's going to, manage the property if it's real estate. So there's a number of things that it's going to do. It'll define when the property, if it's real estate, when it can be sold, how it can be sold, how the profits of the sale or proceeds of the sale are split and paid out. So it does all of that, but it basically is a partnership agreement. Now, a joint venture agreement is properly used in the scenario where you have in real estate. So if it's a real estate investment where two parties are saying, okay, we're going to go in, we're going to buy this property together, and we're going to either fix and flip it. We're going to hold it as a rental, or whatever the case may be. This is going to be an investment, and we're going to go in together and we're going to purchase this property. The proper way to structure that transaction is to have both parties take ownership of the property as tenants in common based upon the percentage of, their partnership interest. So if one party is putting up and going to invest 75% of the funds and the other party is going to do 25%, or whatever the arrangement is as far as who's going to receive what percentage of the partnership, the property should be titled in the name of those parties and reflect on the deed that percentage of ownership. So ABC LLC would own 75%, and XYZ LLC would own the other 25%, or maybe they do 50-50, but they would be on title for that amount. Then you would have your joint venture agreement that further defines the parties' relationships other than just being joint owners of real estate. It will then, go into more detail as to how these owners are going to act with respect to each other and act with respect to the real estate. And that then controls their relationship going forward. A joint venture agreement should not be utilized whereby you have some silent partner that's not on the property, that's not on title to the property. That's really not what a joint venture agreement should be used for. If it is going to be used for that purpose, and you're going to have, a passive investor and somebody coming on, it's almost like what Paul Vincent said in our intro, like you can't just JV it and avoid securities rules and regulations and things like that. In that case, if you're going to do something like that with a joint venture agreement and one party is going to take 100% ownership of the property, and then you have this silent partner that's in the background that is just investing, in that case, you have to make sure that it's, if you are going to do a joint venture agreement in that scenario, you have to make sure it complies with all the securities laws and things like that. And in that case, you need to seek the counsel of a securities attorney. But otherwise, really, the joint venture agreement is properly used where the parties are on title to the property, and it just further defines their relationship. I frankly prefer that the parties in that scenario just do form an LLC for the purposes of acquiring the property and have a formal operating agreement. But sometimes they just like the joint venture, agreement. They like being on title for various reasons. And in that case, yeah, as long as both parties are on title, you can do that joint venture agreement to define their relationship.
I find that it's sometimes hard, Sean, to envision a situation where a joint venture agreement is appropriate for anything other than just kind of a typical one-off partnership. Two LLCs are like, hey, I like what you've done and you bring some value over here. Let's just get together and do this flip or do this one thing and see how it works out. And we can just partner without all the formalities of
Right.
maybe the long-term formalities of an LLC. But beyond that, it's just hard to imagine a scenario where you're not just doing a limited liability company.
Yeah, I wouldn't enter into a joint venture agreement for anything other than what you're describing, which is, hey, this is going to be just a one-off scenario. Or maybe, hey, look, you and I have never invested together, and instead of going through, all the fees and costs of putting an LLC in place and doing an operating agreement and whatnot, let's just joint venture. We'll both go on title to the property, see how we work together. And then maybe if we decide, hey, this works out and we want to do other real estate, then maybe at that point we go and set up a whole structure involving, the two of us and that type of thing. So it's, maybe good to just kind of test the waters of a relationship, more of a dating or engagement type scenario versus a marriage, if you will. And it might work well for that. But yeah, I wouldn't do tons of business using just a joint venture agreement. It's really, in my view, designed for just that one-off scenario where it's, you don't have to go through the process of LLC formation and operating agreements and that type of thing. And you can just use it for that quick, let's just get on title, let's buy this property and define our relationship that way.
Right. All right, few announcements. So today at 3 p.m., we'll be doing the Creative Finance Collective. Participation, as long as we have participation, we'll be holding the Creative Finance Collective. So what is the Creative Finance Collective? That is our opportunity as professionals in the space of creative finance to get together and discuss creative finance. And the participants in the collective are mainly attorneys throughout the country from a variety of different states who get together to talk about creative finance, what they're seeing in their area, their state, what new laws are being passed, what lawyers are doing in their contracts to help better prepare and plan for the transaction itself. And we work together to talk through that. And what we also do is provide and make ourselves available for the entire hour to questions. So if you're watching or you're just learning and you want to find out about creative finance, or you've run into a problem and you want to see how lawyers think through this and work through problems, this is an opportunity for you. You have us captive for an hour to ask questions. So we would encourage you. It makes to ask questions. It makes the space better. It makes it more interactive. Otherwise, we just talk about the college bowl games or whatever else that's going on. But we want you to engage and ask any questions that you have. So the Creative Finance Collective today and every 3 o'clock, assuming participation at 3 p.m. Every Tuesday. So that's Arizona time. And that airs on YouTube, Facebook, and Twitter. You can find it on any of those platforms. Also, if you have questions today, we're talking about taxes, planning for this year, 2024, tax pitfalls, so on and so forth. You need to be thinking about that now. If you have questions, we'll be taking questions in the final 15 minutes of the episode with our guest. So make sure to put those in the chat. You don't have to wait till the final 15. If we don't see that there's any questions, we're just going to move on with the show. But if you have them, put them in there now. We're monitoring the chat. We'll get to those in the final 15, as I said. So let's get into our topic today. We're talking about avoiding tax pitfalls, or we're talking about taxes heading into 2024. And you might be thinking, well, this is kind of an end of the year topic. And yes, it is an end of the year topic, but it ought to be a beginning of the year topic. You need to be thinking about these things now as you work into 2024 and the rest of the year. And with us to discuss that topic is Larry West. Larry, thanks so much for joining us.
Hey, thanks for the opportunity. Always glad to be here.
Yeah, always happy to have you. Larry, I know we've had you before on the show and it was fantastic. And we're excited to have you again. Why don't you tell our listeners a little bit about you, your business, and what you focus on?
Absolutely. Thanks for that opportunity again. For those who I haven't had the chance to meet, my name is Larry D. West III. I own a strategy and planning firm that's based in Dallas, Fort Worth, but we work with clients all over. And our premise is really to help business owners proactively plan around all things related to tax planning and tax strategy. As you know, and we hear this commonly everywhere, taxes tend to be our largest expense. And if we could proactively plan around them, I think we could save a lot and leave a lot less meat on the bone, if you will, when it comes to growing our portfolios, growing our wealth, and doing so in a very tax efficient way. And so we work with, again, business owners, real estate investors, and it's all about how do we create a plan today to save for taxes tomorrow instead of being reactive, worrying about the things that happened last year.
So, Larry, we're at the beginning of a year here. We just came off of 2023, coming in now in 2024. So we're early. We're approaching this about as early as you possibly can. What are there any big new tax laws that you have your eye on, that you're planning for, that the viewers should be thinking about heading into 2024 that might not have been a thing in 2023?
Yeah, there are two that really come to mind here, maybe even three, but the bigger one, especially as it relates to business owners who buy heavy equipment, real estate investors are really going to want to know about this, is the continued reduction in terms of accelerated depreciation. As we go into 2024, we know that that now goes to 60%. Last year it was 80. Years prior was 100%, but now we can only accelerate up to 60% of bonus depreciation for this year in 2024. So that's a big one to know. The other big one to know, and this is important for those of us who have W-2s or who have 401ks as a part of our business, the new change or the limit increase in terms of what you can contribute to your 401k. That's a whopping $23,000 effective this year, and then a $7,500 catch up for those who are over the age of 50. And so they're trying to keep pace with inflation, but now there's more money that we can put away into our retirement accounts. Those are really the big items. Everything else for right now is a little bit of speculation. We're still waiting to see what happens in terms of proposals that are going to come forward. And as you know, as we get ready for an election year, promises will be made. It's just a matter of when they come to life.
So, Larry, one of the things that I think is hot on the radar for a lot of real estate investors, especially those that have, corporate structures and things like that in place, would be the Corporate Transparency Act. We're going to have an attorney on the show that's very knowledgeable with this act next week. So we won't go into it in detail, but, most of your clients are businesses and LLCs. Tell us a little bit about the Corporate Transparency Act and what that might mean for your clients and business planning and things like that.
Yeah, absolutely. So, the first thing that we know about it is its intent. So its intent is not to destroy anonymity, as a lot of people are really worried about. It's really to combat financial crimes, money laundering, and things like that. So on one end, in essence, it could be seen as a really good thing. And all it's really saying is, hey, there's a financial organization, FinCEN, that we have to now report the owners of these entities. We have to now intentionally every year fill out a form that discloses the name of the entity, the address, the EIN number, and who are what they call the beneficial owners of that entity. So there's a clear line of sight of who owns an entity and how the money flows through those companies so that we can combat any financial crimes that may arise. And so the majority of folks out there are going to be subject to it. You want to get with your CPA or your lawyer or perhaps both to talk about which will guide you through filing this form. It became live January 1st, so just yesterday, and it's due this year. And if you're late, the penalties are atrocious. We're talking $500, at the very least $500 per day for being late. That could be pretty astronomical.
And
Yeah,
go ahead. How
go
do
ahead,
they
John.
how will the government collect that? Is that going to be collected, through the IRS, or, who's going to collect those funds?
Yeah, so there's a very specific website that all this information is collected through. I'll try to grab it here before we get off of the of today's session, but essentially there's a FinCEN website that one will have to go to, and they'll have to fill out the form. So it's not connected to the IRS directly,
Mm,
and for tax preparers out there, it's likely not a part of the tax software either. It's going to be an entirely separate reporting.
good to know.
In talking about the laws coming into 2024, you mentioned, you also have on your mind thinking about things that maybe haven't been passed and aren't new laws, but things that need to be addressed. Oftentimes, Congress, whether we're talking about federal or state legislators, have good intentions with laws, and then we deal with the fallout after the fact, whether they be ambiguities or vagaries, or how does this apply? What is this going to look like? Or they haven't thought through what this might look like from a tax perspective. Are there so many laws that you as a tax professional have been waiting and expecting to be addressed that haven't, and which ones are those that you're hoping are going to be addressed in 2023 or 2024, that is?
Yeah, the biggest one, and this is a lot because we work with heavy equipment companies and real estate investors, is if there's going to be a change in terms of the accelerated depreciation item. That's a big one on everybody's list. Again, it's obvious for real estate investors because that's a huge component of the tax advantage that they get, and again, heavy equipment companies as well. Right now, there's been no indication that that's going to change. But I do think the closer we get to either the election or the closer we get to that expiration date, we'll probably see something solidified there, whether it'll officially stay at a certain number or if it'll change and go back up. The other thing that we haven't seen a lot about is what we call the QBI deduction, qualified business income tax deduction. For business owners, especially those that were below a certain income threshold, that was a fancy 20%, up to 20% tax deduction that you just automatically got. And right now that's set to sunset pretty soon. Again, no indication that it's going to change, but it is a benefit that a lot of business owners will start to feel if and when it does expire, unless they do something different with it. And of course, the last one for higher net worth individuals, the estate tax exemptions.
Mm.
Right now, those are exceptionally high, 13 million for single, 27 million for married couples. That too is likely going to sunset over the coming years. And we don't know if there's going to be a change to it. And that could be a significant decrease. We're thinking probably from 13 million, probably back down to about 5 or 6 million, almost cutting it in half. And so those could have really huge implications for forward planning.
I read somewhere that the tax brackets are adjusting, and people might see a little bit more, money on their W-2 paycheck. Is
Yeah.
that so? And what is that looking like?
Yeah, this happens every year. So every year, usually around November, December, the IRS will release the updated tax brackets for the following year, and they're usually in step and in line with inflation. We know the last couple of years, inflation has been kind of wild, so we've seen perhaps some of the larger jumps that we've seen in prior years. But I'm hard pressed to say that everyone or folks will be able to really feel it when it comes to their paychecks, because what they essentially do is they increase the brackets in terms of the rates. And so, let's just say, for example, a 10% rate, just purely for example, is anything from $10,000 to 20,000. What they'll do is they'll adjust it from $10,000 to 22,000. So now you can make an extra 2 grand and not necessarily jump into the next bracket. But when you think about the paycheck, 24 paychecks, 26 paychecks a year, or however those items line up, it's really hard to feel that $2,000 adjustment each paycheck. And so I'm afraid a lot of folks won't notice it, although it's actually there. So I wouldn't put a lot of stock in it to think that you're going to have an astronomically larger paycheck, but you'll save a little bit.
Larry, just jumping back briefly to the estate tax planning side of it, those estate tax exemption amounts, as you mentioned, are relatively high. We don't need to get into those as you've already given the amounts, but you mentioned that law sunsets. So when does that sunset? And the idea here in knowing that it sunsets is that it's almost like a debt ceiling debate, right? Though they probably won't get around to fighting about it until the law's about to go away or until they're forced
Mhm.
to. So there'll be like a critical mass of attention to it at that moment, likely. When are we looking at that law sunsetting and facing kind of those decisions?
Yep. So we're looking at it right around 2026, effectively going into place tax year 2027, with that sunset starting to happen. And you're right. Typically, things like this don't get addressed until there's political events like elections, or until we're right there on the cusp of this thing having to expire. And so I think it'll be a pretty contentious debate, especially with the conversations about tax the wealthy, don't tax the wealthy, wherever folks stand on that side of the aisle. The point is, it has to be addressed. There are going to be some folks who will make it a very big deal. And so I think we'll see some more comments about it probably closer to 2026 when it's becoming a reality.
Now, prior to our most recent law, correct me if I'm wrong, but I believe that the prior exemption amount, you had mentioned it could go back to 5 million. That's about what it was previously to the
Mhm.
current law. Is that right?
Yep, about 5.5 million. Yep.
Okay. Which is itself historically, probably historically high, compared
Mhm.
to what it was before. And now, when it was 5 million, was that 5 million per person, 10 million a couple?
Yep.
Okay. And your thought is that is it your thought that the conventional wisdom is that it likely would pull back to that amount?
Yeah, I think it will pull back, and there's going to be obviously some type of calculation, fair or unfair, to adjust for inflation, and again, the rise in costs that we've seen over the last couple of years. And again, this is my perspective. There's no hard and fast evidence on it. If it does revert back, I can't see it going too far above 6 million, maybe 6.5. But that's where I think most of this would fall.
So if it falls back to that and you're a married couple at 5 to 6 million apiece, you're really not worried about it up through the first 12 million or so.
Right, right, because all of that falls within the exemption. But for the higher net worth, or ultra net worth, as we would call it, that could be a huge missed planning opportunity, because if things are not happening now and your estate advances far beyond that, whether it's post 2026 or what have you, we're talking potentially millions of dollars, right? Up to 40% of your estate could be subject to taxation. And that's not even counting if you live in a state that has an estate tax.
Right, and that was gonna be my next question is for those that fall into that, obviously, if there's a major change to federal tax law that impacts estate plans, everybody needs to be looking at that right away and reassessing whether they need to change anything and have any portion of their estate exposed to estate tax. But, where I was gonna go, and I think you answered this, was for those that do fall into that, what's their current exposure? Sounds like it's up to about 40%. And, the next question would be, uh, do you foresee that percentage changing if they change the law, or was it previously also similar in the prior legislation?
Yep, so that one was similar in prior legislation. I don't foresee that one changing. And again, this is my perspective here. It's already exceptionally high, right? Up to 40%. depending again on what's happening with promises that are made during election cycles, there probably is going to be talk about that number going up. I think they'd be hard pressed to really pass it and to make it happen. So I think 40% is relatively where it will remain. But again, when we're talking at that level, tens, 20s, $30 million, that's a pretty significant amount.
Mhm.
Talk to us about capital gains. This is a favorite among investors. Are there any changes? What are we looking at in 2024 in terms of capital gain rates? Have there been any changes? Is it the same, and what is it?
Yeah, so early, perhaps pre-2023, 2022, there was a lot of talk about Biden's Build Back Better plan, changes to capital gains. A lot of that has died down, and that hasn't come to life. So as it stands right now, we're not expecting changes for 2024 at least for capital gains tax rates. Those will stay at 0, 15, or 20%, depending on where your income ultimately falls. And we'd expect that to stay the same. But again, as we get into these political cycles, discussions will be had, promises will be made, and so there is a possibility that capital gains tax rates will come under scrutiny. And the reason that that will happen is because capital gains are considered favorable. And as you move through your earning cycle and you move more into the investor side of things and you own equity, you own assets, when you make those transactions, it's considered capital gains tax, which is a lot more favorable, 0, 15, or 20, than perhaps a 37% tax bracket. So we could see that come under some type of revision, but for now, they will remain as they are.
So let's talk about planning. I know that as a professional myself, I place a high value on working with people that know what I don't know and are paid to know what I don't know and paid to know it well. And I like to stay tapped in, as I know Sean does, into taxes, and I like to find any way I can to, work within the tax code and benefit myself and my business, so on and so forth. But I also know enough to know that I can't do that. I don't have training to do that. I don't have schooling to do that. I don't have the interest, frankly, to know it at that level. So a lot of it's about surrounding yourself with, I think, the right people. I think the beginning of the year is as good a time as any to really talk about this and plan for this. But what do you think about how important is it to find the right professional when it comes to taxes for you and your business?
Very important, very important. As we started out, taxes again often are one's largest expense, especially as they start making more and more money and climbing that earning ladder. And so to proactively plan is really the best way to mitigate against taxes because quite often the cycle is I have a heck of a year. Some amazing things happen. Oh crap, what's the tax bill going to be? Whereas when you proactively start planning, as those amazing things are happening, or even as you forecast those things to happen, you can have conversations with your tax person to see what moves you need to make before the end of the year to either mitigate the tax or just so that you're not surprised and you know what your tax bill is going to be. If you're doing the proactive planning throughout the year, there are very few things that could surprise you in April. But if you're not planning, then a lot could happen.
Yeah, so give us an idea in your own practice so that a listener might have an idea about what you would consider an A plus client, somebody who's thinking about this early on and utilizing you in the best way that you can be utilized. What does that look like throughout the year?
Yeah, I would say at the very least, it's going to be two meetings, perhaps even more. There's one that should happen right around Q1 and another one somewhere around Q3, Q4. And again, more if needed. But those are check-ins to see one, what do we think is going to happen this year? How do we plan accordingly? A lot of times, especially business owners, they know transactions are going to happen. They know some things are going to change with their business down the line. And as an accountant, if we can know those things ahead of time, we can forecast what we think the outcome is going to be and also give suggestions. And so at the very least, we're having two meetings, but likely we're having more, maybe four meetings, one per quarter, to just check in and see how things are going. That last meeting, as we come to the end of Q3, right around Q4, is really just our shore up to say, hey, were our assumptions met? Do we need to pivot or change and do anything different before December 31st? all things involving, I'm going to use 2023 since we're in 24 right now. All things involving 2023 should have been addressed by now. So when we talk about the A plus clients, we've already had those conversations around October, November. And now the conversations we're having is just to shore up those assumptions and start planning for 2024. Staying ahead of the curve.
So they shouldn't be calling you at 5 p.m. on December 31st to find out what they need to do right there at the end.
Exactly, exactly. At that point, it's almost too late.
Yeah, well, I know just in my own experience, if you're not planning, especially if you're a business owner and not everything's just a W-2 paycheck not going to change throughout the year, and it's harder to predict. Having, benchmarks of where you're at throughout the year to know, okay, have I been holding back enough? Do I need to plan for
Mhm.
more taxes? Are there ways that I can, turn this money, maybe put more into a 401k, or do I donate more? Sometimes I found also just in my own personal life that early planning allows me oftentimes or encourages me to be more charitable than maybe I would have been, because you're thinking about, okay, what can I, if this is going to have to be taxed one way or the other, what be thinking about in this next quarter, what you might do or where that goes, and you really have a plan in place.
Yep, absolutely. I agree with that.
So let's talk about other professionals. I guess looking back at what you would consider your A plus type of client that you're working with, do you advocate that they ought to be thinking about, and I know this all has tax consequences, so I would think that you would be, but that they're working with other professionals with their business as well, whether that be financial planners, lawyers, so on and so forth?
Yeah, absolutely. I think the dream team really consists of a tax professional, a legal professional, and a financial professional. And all three of them, and there may be others to include in that circle, but that's the core three. And all three of them need some type of hub for communication because oftentimes there's crossover, right? Legal decisions may have tax implications may have legal ramifications. It all filters back to the financial side and how it comes back to the owner. And so, really, really good planning should involve all three of those. But sophisticated business owners, as they grow their business, need to have at least those three as a part of their advisory team because it could save you thousands, if not millions of dollars, just having that core group.
So when we talk about attorneys, there's obviously different types of attorneys. And so, if you have a real estate investor, I'm assuming that, they're going to be unlikely to find an attorney that will meet all their criteria, be able to handle everything that they need. As far as attorneys goes, what categories of attorneys do you think, say, a real estate investor would want to have, employed by them to assist them with their various needs?
Yeah, that's a great question, and I think you'll better help me better shape this if I put this in the wrong context. But at the very least, an attorney that's well versed in real estate. So I'm going to say a real estate specific attorney, because if that revolves around the operations of their business, the deals that they're involved in, contracts that they're entering into. That part needs to be lined up. But I'd also say they need one that is experienced in terms of litigation because not
Mm.
all attorneys are going to be the ones that actually go to court. Some will keep you out of court and some will fight for you in court. And so I think they need one, whether that's a business specific or just a real estate specific one, that is familiar with litigation to help navigate if and when that arises. Those would be the two ideal ones. Before we branch into more specific spaces like estate planning, then of
Mhm.
course we want an estate attorney specific for that one.
Yeah, and then you also have, your asset protection attorneys, as
Yes.
well. Sometimes estate planners can be, assist with the corporate structuring and stuff like that. But at the end of the day, I mean, I don't know about you, but a corporate structure, in my view, is not complete unless you have some form of estate plan on the top of that structure that deals with what happens if the ultimate owner passes away, that plans for estate taxes, those types of things.
Yeah, I couldn't agree with you more on that one too, especially because when you're putting those structures together, at least where we try to start is what's the end goal? What do we ultimately want to happen? Whether it's sell of the business, pass the business down to the family, all of those have long-term and estate planning implications in them. And so I'd agree. I think no structure is complete unless you have that estate planning piece ironed out.
So, Larry, for somebody watching and they're thinking, okay, it's January 2024. I've set all my resolutions in place. I'm gonna go get a professional. This sounds great. I need to be thinking about this now. In your experience, what's the best way for individuals to find a good tax professional? Because the internet is a little bit like Netflix and Prime Video these days. You sit down to go watch a movie, and there's so many stinking choices that you just give up and you don't do anything. How
Mhm.
how do you find is the best way for folks to find professionals like yourself?
Referral, right? And
Mhm.
so when you're in the company of people who have done the things that you want to do, accomplish those things, you're in really good company because it allows you to elevate and grow your business. Well, those people likely have a team behind them. Let's get a referral, excuse me, from them to see who they've worked with, how they like them, and perhaps even what they've missed out on. That's really the best way. Outside of that, you may have to kiss a couple of frogs before you get to the prince. And so interview, interview, interview. There's nothing wrong with scheduling the discovery call, learning more about the firm to see if they're a good fit. The ideal things I think folks should look for in their professionals, someone who has a niche level expertise in their particular area. So if your business is all real estate, let's look for a tax professional who understands real estate because they'll likely be able to make you aware of blind spots that generalists just don't see or just aren't aware of. So making sure you're working with people who understand and know your space, but certainly take referrals from folks who've done it at a high level that you aspire to be like.
Yeah, that's really good, and I think that really spells out the reason why you have a professional team because, these professionals, uh, whether it be a lawyer, a tax professional, are oftentimes involved in meetings with other professionals with, sophisticated clients that need those kind of questions, so they've already worked together. They can already come recommended. That is a huge benefit. For somebody who's just, "Well, I'm starting from scratch, I'm gonna find whoever I can find locally," what are the kind of questions you would ask if you were them just to try to find out, "Okay, is this the person I want on my team, or should I keep looking?"
Yeah, absolutely. So the first one is assessing their expertise again in your specific field. And that's asking them questions around perhaps how many clients they have in that space, if they specialize or niche down in this particular space, really just getting the feel for if they understand your industry and understand it at a high level. The second one is their response time. We know in our industry we have a shortage of talent, and so a lot of firms really struggle with it. But I think the true value add here is if and when you have a question, you know you're going to get an answer within a respectable amount of time. So you'll want to just gauge their capacity to make sure that they're available to respond to you. And then the last part is how often will they meet with you? If it's just one time and it's tax preparation, that probably isn't the best fit, or you need to find someone else who does the strategy. If it's multiple times throughout the year and it's planning and strategy, that's usually a more ideal fit because it allows you as the business owner to avoid surprises. So making sure that they're in your industry and they understand it at a high level, making sure that they have great response time and they're available to answer your questions, and then ultimately making sure that you're going to have more than one meeting so that you can proactively plan throughout the year.
How often do you think price gets in the way of individuals making poor decisions when it comes to tax professionals? I think a lot of them get it in
Yeah.
their head, I just need a tax preparer to fill out a complicated tax return. And I know that
Hmm.
in business, it's a long tax return, but you're just filling in boxes, file the thing, and I want the cheapest rate possible. I get the sentiment. I get the idea of trying to save money, but if you're thinking about a tax professional as somebody that's more than that and an advisor, seems to me that's gonna be a calculus that ends up getting in the way more often than it helps.
Yeah, I agree, and I think we see it too often as well, where price does become a barrier because of those preconceived assumptions that you just mentioned. I just need a data entry person. All you're doing is recording what my QuickBooks says. Is a lot is what a lot of folks believe. But here's the deal, especially with the core three that I talked about: legal, accounting, and tax, as well as financial. If those folks make a mistake, if you skimp and you get what you pay for and you go too cheap, the cost to fix it is typically far more than what it would have been had you just paid the reasonable price to begin with. And then you also think about it from a return on investment perspective. If you're working with these folks, what ultimately are you getting as the ROI? Again, on the legal side, if I have a really good attorney who can keep me out of litigation, I would pay the cost all day because the cost to actually go to court is astronomical. The same is true with tax and accounting. If I have a good proactive planner who could save me a couple thousand or a couple million or whatever that number is per year, whatever I have to pay them, as long as it's less than what I had to shell out to the government, that's usually a good ROI.
Speaking of mistakes, and this is one that we see over and over with real estate investors, is they put long-term hold real estate rentals primarily into S corps. So, as we roll into 2024, talk to us, number one, about the problem with that. And number two, what is the solution? I mean, can that be something that is addressed for, let's say, an investor is like, oh, shoot, I really messed this one up. Is that something that can be addressed or solved, in 2024? And what does that look like?
Yeah, that's a great question. And whenever we do our workshops, that's a key part that we talk about. Unless there's a very specific reason, especially for real estate investors, we almost never put real estate property that we own under the corporation structure, whether it's an entity taxed as an S corp or C corp. The main reason is it starts to erode your tax benefits. Without going too far into detail, S corporations have this funny little thing around basis. And so you can't include debt as a part of your basis in the S corp, which means when you get these huge waves of depreciation, which typically happen with real estate and it pushes your net income negative, it eats away at your basis, which then could subsequently make your distributions taxable. That creates a problem and destroys the entire point of having um, real estate in general, but also having the S corp. And not only that, S corps are there to really get rid of or mitigate against Social Security and Medicare tax. Your real estate rental income is not even subject to that taxation, so you typically don't need it. That's why we encourage people to stay away from it. It's not needed most of the time, and then it erodes tax benefits very, very quick. And it's not a welcome surprise when you take a distribution and find out you got to pay 15 or 20% on it. Um, Now, what's the solution? Besides don't do it or talk to your team ahead of time, you have to plan very, very careful because when you move assets out of a corporation, that's considered liquidating, and that could have capital gains or ordinary income tax implications. And again, it could be a very unwelcome surprise. And so it's possible to move it out, but a lot of things have to align appropriately, and you'll have to do some hyper planning with both legal and tax to make sure you minimize implications on both sides. Far more
So,
expensive to fix though than to set up correct the first place.
Oh yeah, for sure. And we've seen it, or I've seen it with my clients. And for the most part, they just leave it in the S corp, and then anything new they put in a partnership taxation structure.
Yep.
so let's dive into that in a little more detail. The corporate restructuring, that is, if that is something that's on the radar for a business going into 2024, I would imagine that's something that they would need to start early. What does that process look like? And maybe the process looks like a whole bunch of different things because there's a lot of different restructuring that can be done, whether depending on what you're going from and to.
Yeah, and that certainly is more of an it depends question, but that conversation ideally has to start one with the business owner just having the vision or at least being able to articulate what is the end goal, what are we trying to accomplish here? And then that rolls into either meeting with your accountant or your attorney, or perhaps both of them at the same time because the structure that the attorney may put together may be great and insulate you in terms of legal protection, but it may just have terrible tax implications. So now the accountant needs to get involved. And conversely, the structure the accountant put together may minimize taxation, but just leave you exposed legally. So that conversation needs to be molded between those two parties and crafted until it is perfect and done in the best interest of the client in meeting their goals. Until that happens, again, just countless meetings, accountant, legal accounting, until we get that thing perfect. And then ultimately, after that, it's just a matter of what date do we want this to be effective. But that would be the process I would think folks would start with.
So, in addition to that, this show is obviously a show for real estate investors, and there's this thing I understand, real estate professional designation, and there's tax advantages to that. What is that? What's that process look like, and what are the advantages to it?
Yes, yes. So this is a very important topic, especially for real estate investors, because we have too many influencers on social who explain how to do this, but they explain it wrong. And they explain it in a way that will get you hosed if an audit ever shows up. So
Mm,
here's why real estate professional status is important. Naturally, the IRS considers real estate income to be passive income, which is why it's not subject to Social Security or Medicare tax. On the other side, they deem real estate losses to be passive losses, which means you cannot use those losses to offset active income unless you qualify as a real estate professional or maybe some other nuanced tax out there like a loophole. But more often than not, it's qualify as a real estate professional. You do that three ways. One, more than 50% of your time has to be in what they call real property trade or business. Two, 750 hours per year need to be spent in real property trade or business. And so just looking at those first two, more than 50% of your time, which basically means you probably can't own and operate another business or have a full-time W-2 and still justify more than 50% of your time in real estate. But all that aside, those are the first two. The last one is you need to materially participate in your rental portfolio, which means you got to own some real estate. And that's the
mm.
part that a lot of people miss, is that they assume that they could be passive investors in all of these different investments and still qualify as a real estate professional and not have any material participation. So once those three things come together, then you could qualify, and you need to make sure the hours are documented, the activities are documented in a way that would protect you from an audit. Again, most folks get it wrong, but those are the core things that need to happen first.
So break out that last prong when you say you have to be an owner, you can't just be a passive investor. Does that mean you, as the real estate professional, have to be entitled to some property or the property in question?
Yes, yes, because basically what they want to prove is that you actively manage your own rental portfolio, that you're not just doing what they call investor related activity. Because if you're exclusively doing investor related activity, and I'll talk about what that means, then essentially you're going to remain passive. There's no avenue to active. But when we look at material participation, that basically means you vetted a tenant, you changed a doorknob, you've managed a contractor, you've changed a window, something that your activity is necessary for the operations of the real estate business to continue. If your activity is not hands-on, and let's just say, hey, I made calls or I went and saw some properties or all those other things, arguably that's not hands-on participation. Whether or not you make a call, the business will still operate, rent is still due on the first. But whether or not you change a doorknob, that's totally different, right?
Mm.
Because then we have other issues with the tenant. And so you think about it from the perspective of what hands-on active activity can I do or have I done at the property? That's what constitutes material participation.
So then it's more about the participation than it is the formal ownership. So I could have my own member managed limited liability company that I'm the only member of that owns the property. So that my LLC owns it, and I basically, as the member or the manager, act as the property manager. That would be sufficient.
Yep. So in an example like that, that would be sufficient. Now, I don't want to say ownership doesn't matter, because there's still a rule that you'll need to own at least 5% or more of the property or of the entity that owns the property. But yes, what you just described it is correct. LLC owns the property, and then I, Larry, actively manage that property as the property manager. As long as I meet those standards, 50% of time, 750 hours, and manage the property, then I could qualify for real estate professional status.
So, Larry, we've touched on capital gains, and one of the biggest golden tickets out there for capital gains is owning your own personal residence that you live in for 2 out of the last 5 years, and then selling that, and you have a pretty big, exemption or deduction you can take for against the capital gains. Um, so, there's scenarios where people live in a property for 2 years. They decide, oh, well, we're going to move on. We either relocate or we buy another house, and then, well, let's turn it into a rental. And so they turn it into a rental. Now they can rent that for up to 3 years and then sell it and not have to pay any capital gains. What should somebody be thinking about if they've done that, and in going into 2024, as far as what are the options as far as selling it, doing something with that property? What's the thought process there?
Yeah, so three things really come to mind. The first of which is that this exclusion is called the 121 exclusion, 121. Um, if you do convert into a rental property and you sell, even though you qualify for 2 out of the last 5 years, that being your main home, there's still a portion that you will have to pay depreciation recapture on
Mm,
because it still was an investment property. So there's always a nuanced calculation that happens on the back end that a portion of that gain could be taxable, which is where the proactive planning comes into place. And so if it's your main home, you never rent it out, it never becomes business, then the exclusion works exactly as described. If you converted it to rental, or perhaps even convert it from rental to personal, it could go the other way. There's still an element that you may have to pay taxes on just because it was a business property. So that's the first thing. The second thing is, do you truly want to sell? Have you exhausted and extracted as much as you can out of the property? One of the things we always say is don't sell grandma's house. And the reason we say that is because real estate could be a very powerful estate planning tool because we know the step up in basis rules. If we've had it
mm,
for a while, it's appreciated over time. Maybe we've paid down the debt. If that property is then transitioned to the next generation and done appropriately, the step up in basis could provide huge tax implications for the next generation and also provide huge tax savings as well. Um, and then, of course, the third thing to consider there is the timeline, right? The 2 out of the last 5 years. If you're coming close, you got to make sure that everything is going to line up and that property will close. If you close past the time frame, we could have just lost out on some major tax savings there.
Larry, give us here. We're coming to the end, and I wanted to. This is a question we had hoped to ask you the last time, and we had so much information we never had time. But being that our show is a show for real estate investors, we wanted to get from you and planning into 2024. What are some creative and unique tax strategies that real estate investors can employ to reduce their tax liability? If you've got somebody asking that question, what's a creative thing they should be thinking about going into 2024?
Yeah, this is spoken like a true conservative accountant in a sense. Before we get to the creative, let's make sure we've got the basics. And again, the basics is really depreciation. And the reason I point this out is because when you use what are called cost segregation studies, which I think the audience will be familiar with, that's a huge depreciation deduction that you get right away in year one. But if you've got additional capital expenditures that happen each year thereafter, do you need a cost segregation study every year? Probably not. Maybe the creative thing you need is an expense um, policy within your real estate business. So, for example, any expenditures that are below $2,000, we immediately expense those on the P&L. We don't capitalize them and put them on the balance sheet. What that means is we can just write it off 100% as a regular expense and not have to worry about being limited by 60% bonus depreciation. So a company policy specifically on the accounting side that details how your expenses are allocated between the balance sheet and the P&L could save you thousands of dollars and remove the 60% limitation, and now you can write it off 100%. Um, the other thing to think about is really creatively how you exit your property. 1031 exchange tends to be the go-to strategy there, but there could be other things for you to consider. For example, if you want to donate this property, or perhaps not even donate, but sell this property to a charitable organization, but you want to sell it for below fair market value, where there's a tax strategy and there's a tax way to do that. A 179 exchange is essentially what you can look into, or perhaps Delaware statutory trust, deferred sales trust, all these different things that can happen around the exit. So don't just go right to market to sell. Talk to the tax, talk to the legal side, and see if there's a creative way for you to structure that sale in a way that ultimately saves you tax dollars on the back end.
All reasons why you need a professional in place.
Absolutely.
Yeah. Yeah, my eyes glossed over. Well, Larry, we thank you so much and appreciate you being with us. Tell our listeners how they can find and connect with you.
Yes, thank you. Certainly appreciate it. So to get in touch with us, our company, Precision Business Strategies, we're at PB, like peanut butter, pb-strategies.com. There's a big blue button on the top right-hand side that says Become a Client. That's where you can schedule a discovery call and talk to our team and see if it's a fit for us to work together.
All right, Larry. Well, thank you so much for being with us, and let's do it again sometime.
Absolutely. Thank y'all.
All right, you
Thanks,
have a
Larry.
good one. With that, everybody, that is our show. Thanks for joining us. Make sure to be at the Creative Finance Collective today at 3 p.m., and we'll see you next week. Have a good one.
Have a good day, everyone.